What's going on, guys? SmartHelping.com here. It's June 30th, 2017, last day of the month, and I've got a financial model here. It's definitely one of the best I've done, and I've tried to implement every single possible thing that I think is most relevant for use, and made it as broad as possible for the type of business that it's for, which is going to be a broad-based business. So what it is for a website or an app. Anybody that's going to start a website or an app can use this if they plan to have users that have to sign up for an account. Now the functionality is that you can either you have free user signups, then you have a conversion of your free users to paid, and then you have a breakdown of all your paid users in 5 different revenue tiers, which you can define. You're also going to have a option for direct traffic acquisition. So users who just have come through the site and sign up to a paid version, so you can bypass the whole free version or free account if that makes sense for what you're doing. So, and that's it. If you have that type of business, this or business plan or idea for a business, or trying to value that type of business, this is going to be it. And obviously there's a lot of businesses that have websites with users and apps with users that pay something. So we have built a model to help you with that. And some of the most important stuff is the summaries, the cash distribution to investors, a lot of visuals. We've got a monthly and an annual detail. We've also got a 5-year summary, and we're going to get into it. So I've got a blank template that I'll send when whoever, if you purchase it, I'll send you a blank template. I'll also send you a template where I filled stuff out so you can kind of see how it works. So one of the most interesting things or useful things is to have a sensitivity. And I've picked some of the most important factors that you're going to want to test. So traffic growth rate, conversion of traffic to free account signups, conversion of your free traffic to paid, your churn rate of all tiers, and the price of all tiers. So what you do, you go into the base revenue tab and you can build out all of these assumptions. So we've got our starting monthly traffic, and then we've got the monthly growth per year of that traffic. You've got conversion to free users, percentage of that month's traffic that goes to free users. You've got a percentage of your traffic of your free pool that churns. You've got a conversion of your free pool to paid users. You've got direct from traffic to paid. And obviously you can set this up if you don't have any free users. You could just assume all your free users are 100% going into paid, and that just takes away the step. So it's easily dealt with if depending on what your situation is. You've got percentage of free user pool converted to paid. So some of your free users will go to paid. You also have some of your, let's see here. So this is conversion of free to paid. This is the percentage of direct additions to your free pool. And then the 1% is just saying of your total free pool each month, because you have, a set amount of users that are there that have been there for a while. How many of those people sign up? So obviously that's going to be a lower percent. We've got the percentage of your paid users that are in each tier. So here we've got 20% in tier 1, 15% in tier 2, and so on. Also, you can pick the start month of, which is based on a 5-year monthly data validation based on the first date you enter up here, which this will be always the first day of the first month of the year, whatever year you plan to start an operations. It doesn't have to be the start date of project, it just needs to be the first day of the year's date. And then you get a nice 5-year summary. And then I've added functionality so you can pick what dates each of your revenue streams starts. So if you pick, in a year, October 19, this pool for paid users, tier 1, is not going to start until then. And if you go over to our monthly, we go to our tier 1, you can see there's nothing here until October 19th. You can see it starts, and if we do, let's say we put it back to May 19th. Oh, now look it, we start in May. So all of that works, and trust me, the logic, it took me a lot of hours and a lot of focus and a lot of checking to make sure all of this works. Okay, so you've got your revenue. This has to always add up to 100%. However, if you can have users that are in multiple pricing tiers at one time, then these don't have to add up to 100%, which I've made notes on all this, and I've got notes kind of in each cell to explain and define what everything is, and obviously you can reference back to this video if you have questions as well, because anybody can view this video. It's free online. We have our monthly pricing tier. So this is each of your pricing tiers 1 through 5, and by year, how much are you charging those users? It might be the same all 5 years for each tier. It might be, you might go up in price. It just depends, whatever you want to do. You also have the churn of each tier. So this is of those users that are in each of your tiered paid various accounts from tier 1 to 5. How many of them are leaving each month? And that's where you define it here. So we've got, just this, I just put in numbers here. It doesn't mean anything. It's just random, but let's put this back to January. So that's where these assumptions go. Now, after you build this, you can use these sensitivities. Now, base is just going to be what you have in here now. That's why it's called the base revenue. However, if you change some of these key growth drivers, let's say we put our traffic growth up to excellent, that is going to, this didn't change anything here, but now look, you see this is 10%, every 10%, 10%, 10%, 5%, 5%. If we go to our revenue sensitivity, look at now it's 13%. 13, 6.5, 6.5. So you can see it's gone up by, and I've done increments and I've made a note here. Every increment is 15%. So base is obviously no change. Better would be 15% better. Excellent would be 30% better. Bad would be 15% worse. Worst is 30%. And if you see I put worse here, and we go back over to revenue now, look, it's only 7%. 3.5. And starting at 1,050 monthly, your monthly traffic. So that's important. So once you actually build your scenario, you can control and look, okay, what's it look like with excellent, base, better? What about conversions? What if my traffic growth is better than expected, but my conversions are worse? You could do that. Go excellent here, worse here. Now churn, you will note that if you do excellent, that means your churn rate is going to go down. So look at our churn, it's at 3% across the board. If we put that to worse, then it should be higher, which it is, 3.9%. If we want our churn to be excellent, that means it's going to be lower, so we're losing less people a month. We have see, our base is 3. Oh, whoops. I put the price up to excellent instead of the churn. So if we put churn rate to excellent, you can see, yep, lower, only 2% a month we're losing. Now you can use that to project out, we could project out lifetime value of the customer and lifetime value of your pool of customers. Now that's actually a metric that we're going to have as you move on here. I've added a whole bunch of specifics such as customer acquisition cost, months to pay back your the cost of the customer acquisition. And some of those are very important once, because it's hard to calculate those when you have a whole bunch of different things going on with revenues, expenses, etc. So let's keep going here. Okay. So we've got our revenue modeled out. Let's go look at the operating costs real quick. So same deal, you can pick the month that the cost starts, and then these are all fixed. We've got sales and marketing, and I've made notes about that there. You can put in anything you want in the cost detail. The only thing you have to make sure is that there's no duplicates, because then the index match function is not going to pick it up right. So no duplicates in this column, even in any of the sections. There can be no duplicates, which shouldn't be an issue because you should be putting unique costs in here. So sales and marketing, simple. You enter the date, you enter, okay, what's my monthly VP of marketing for year 1? Well, let's say we don't even have one. Let's say it doesn't start till year 2. You could fill out, let's say, I don't know, $5,000 a month. Year 3, you'll do $7,500, and then we can go up flat there, and then maybe year 5 we go to 85. And let's say we're not going to hire anybody else in the whole business, just the VP of marketing for now. We get founder CEO. Start take a salary. Year 3, do $6,500 a month. Drag that across. We could do year 2 as well. CTO, need you start in the first year. $5,000 a month for every year. And you can get the idea, like you just go through all of your costs, R&D, general administrative, sales, marketing. You pick the date they start and pick their monthly amount for each year. Straightforward. We got some cost of goods sold here, fixed cost of goods sold. So customer success, other fixed cost of goods sold. This could be anything, but it has to be considered a cost of goods sold, or else you need to find somewhere else to put it up here. And then again, let's say do $3,000 a month for all the years. So do maybe 5,000, 6,000. Then we've got our variable costs. So we've got 5 possible items for variable costs directly related to monthly paid users. So this is going to take your monthly paid users and multiply that number by whatever you put in here. So say each user is going to cost us 50 cents for our server. Yeah, put it in there. We got other costs here. Let's say there's I don't know, 2 cents a user for something else. Just anything that you can think of that's not already included in all these costs up here. Okay, the next section of cost of goods sold we have is based on monthly revenue, and it's simple. What is your monthly revenue? And these are costs directly related proportionally to that. So let's say payment charges. You're obviously accepting online payments. Let's say your net percentage is 2.5% on your total revenue, and you got nothing else for now, and that starts in the first year, first month. Now you'll note these months, our validation that automatically update based on what year you've chosen. So if I were to put 2019, then what I would be able to choose is the first date would go to 2019 January over to 2023. So it's automatically 5 years worth of months. Put this back to 18 for now. So this is based on monthly traffic. So we've got by user, we've got by revenue, and now we've got by actual traffic. So let's say hosting is, I don't know, 25 cents. That seems expensive. Maybe 10 cents for every person that visits your site for the month. And I don't even know if that number's accurate. So now you filled all your costs. We've done our base revenue. We're gonna put this back to, instead of excellent for now, we'll put this back to base and this back to base. We'll talk about some of these other controls. I've got everything explained, but we can go through that too. Just stand by. We got our base revenue. Now, this is probably the most important thing of the whole revenue, is how much of your traffic are you actually able to convert to someone who makes an account with you, a free account. And then obviously the next important one was, how many people of your free accounts are converted to paid, and then also how much of your free traffic can you convert to paid. So 1% here, it just depends. That's going to depend on your website, and you got to build some cases and do some testing to figure out what you can get. But these conversions are going to be super important to how much revenue you make. Okay, so we've got all of that. We got our operating costs, startup costs. Let's just say, if you're going to build your app, who knows, it could cost anywhere from $7,000 to $20,000. Let's just do $15,000. So we make an app, $15,000. Or website design also could be costly. If you do both, let's just do $15,000 for both. Any R&D that's going to happen before you actually begin, paying people in R&D. Servers, reserve, any other fixed one-time startup costs that you could think of, you'd put in here. Next we have financing. Now there's a lot to talk about between financing, investors investing, and then how much money you, the business owner or the founder, is going to have to put into the business. It gets pretty complicated, but at least for now, let's look at the financing tab, and let's just say we want to finance. We need about $300,000. Now this is assuming your business is not profitable day one, and that you're going to need some cash before you actually begin. Now that might, you might be pretty profitable day one, and it might not cost you much. In that case, you might not need that much startup capital, which is fine. You just put 0 here. But you put the financing amount, the loan term, interest rate, payments a year, and then obviously you pick the first date that you're going to start making loan payments. From there, we've got visuals, which is really helpful. And let's just start. We've got paid users versus free users. We've got total monthly recurring revenue, aka MRR, versus total free plus paid users. We've got your customer acquisition cost by month. You see this is going down, and the reason why this is going down is because your user growth is growing outside of the costs of customer acquisition, which means organic growth, some of that free traffic, and direct to paid. All of those factors are making this go down over time, which is obviously you want that to happen. Months to pay back your customer acquisition cost. So this chart is showing you by month how much the users you added were able to pay back their costs. So at first, we were pretty high here, 162 months. because we've got a lot of costs and not that many users. But as we scale down here, it gets lower and lower. Again, probably somewhere around 8 months is good, 7 to 8 months. So you can see here around October 20, we're getting around that number, 5-7 months to pay back. That's pretty good. But again, this is all made up numbers. I'm just showing you what the charts mean. Now here we have running cash position of project. So this is not going to take into account financing. All it's going to take into account is the startup costs, which you can see there are 30,000, and then it's going to say what is your operating cash flows aggregate to over time. And you see here we're going red, 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 but then we break up around June of 2022, actually March, and then starting to build a cash balance. Now this does not take into account any financing or obviously debt payments. We have another chart for that will include the option of financing and paying back that debt over time, as well as paying back the loan at the end of the 5 years or whenever you decide to make the exit. Which again, on the controls, we're going to go over this, but you have an exit here. You can pick the date, and based on that, whatever date you pick here, any month after that is going to be blank, which is coded into the model. And then this will value the business based on your recurring annual revenues run rate, and it'll multiply that month by 12 to get that figure, whichever month you choose. So let's see, running cash position. So that is including that, which we just have it at 0, so it's not doing anything. If we were to put this at, let's say 1, it's going to add 1.7 million to the cash flow. So if you go to the visual, boom, you just see that in the last month right there. Revenue and expense breakdown is just showing you your revenue, your gross profit, and then your 3 main categories: sales and marketing, general administrative, and R&D. What are those related to your sales and gross profit? Gross profit margin, just pretty standard. Got it going to 74%. Your net paid user growth versus total paid user growth. So this is the amount of paid users you're adding less the users that leave, which would be the net, and then your total, which is just how many total users have you added. So that's a comparison. You've got leverage cash position, so this does take into account paying back the loan and the cash payments every month. So you're gonna not keep as much, but then you don't start in the hole, obviously. And then this is good. You can see I've done some things. So the lowest gets to 755. That's because I've built in some logic so that you can see, based on your negative cash flows at the beginning of the business, the first couple of years or months, you can see how much cash you actually have to have out front to survive the burn. Then we've got customer lifetime value. We talked about that a little bit, but this is just saying, over time, what is and it's going to base on your churn rate and your gross profit of your users. So it's basically, this is going to be gross profit of your monthly gross profit of the month times 12, and then that's going to be multiplied by the amount of years you expect the user to stay there, and that number of years is simply calculated by 1 divided by the churn rate annualized. So if your churn rate is 3%, you're saying that's 36% over the year. So if you do 1 divided by 36%, you're going to come somewhere around 3 years that you expect the user to stick around. And that's obviously not going to be perfectly accurate figure, because who knows what your churn rate really is, but it's obviously this model. So and that's how you get it. You get the years multiplied by the gross profit. That's the lifetime value of the customer. And it's negative up front because gross profit per user is negative, and that's just because of our assumptions. which would change if you changed your assumptions. And that's the beauty of this, is that you can really account for a lot of different scenarios accurately and in a timely manner, so you can see when things happen. That's important. And here I added just a big chart. This is your users per tier and users and MRR per tier. So you've got all 5 tiers, and you've got the monthly recurring revenue of each tier and the over here, and then the actual amount of users in each tier over here. I think I did MRR is the lines and users are the bars. Still, it's kind of hard to see, but I thought it might be interesting, and it might be more clear if you say you only use 2 or 3 of the pricing tiers. Then it'll be easier to see. It just depends on what your own situation is. So those are all the charts. Distribution. So this is getting into, what have your investors put in? What have you put in? And then I also added a scenario down here, assuming no investors put any money in, but you get a loan out. The investor scenario assumes it's not taking into account any loans. So it's assuming you and the investor together will fork up all the money up front to get things, make sure you got enough to run the business. So it's just got the project cash flow up here. And again, that project cash flow does not equal any debt payments or debt service or anything with the bank whatsoever. Then we got investor cash flow, and now that's 0 right now because the investor is not investing anything per this. If I were to say they were, it would show up, let's say, 150,000. Now they have 50% internal rate of return based on the 150 they put up, and then this is their share of the returns based on the amount they put in relative to the amount needed. We got discounted cash flow, and then we got your net present value of those would be the sum of the discounted cash flows. Then sponsor a company, so this is all the cash that's left after the investor gets paid. IRR is going to be the same because they're proportionally the same cash flows. There's the actual dollar amount of those cash flows, which these and these will add up 2.2 million. What am I doing here? Oh, this is 2.749, and then this and that add up to 2.749, which they do. Then down here we've got leverage scenario with no investors. So leverage project cash flow, this is including the loan you're getting, if any. And oh yeah, I put the 300,000 in there. So it's including that, which the net of 300,000 in your startup cost of 30 comes to 270. Then you've got minus 122, 122. Then we're starting to get a little positive cash flow here. Now the interesting thing with this is you can see the effect of financing or not if you're just doing this alone. So you can see financing increases your internal rate of return, but your actual cash flow you're getting is less. So you can see this is totaling 2.5 million. If we say we're financing none, and hold on, let me actually, the IRR 68%, and you're getting back 2.5 million. If you do 0 here, you're getting back 2.74 million, so it's more money by about 200,000 ish. But look at the internal rate of return, it's gone down to 50%, and that's because you have to put more money up front, 378, opposed to if you finance some of that, you got to put up 193. And then this does include paying the bank back, and it also includes an exit value if your exit value is, we put a 1 multiple on the recurring revenue for according to month December 22. So that's how that part works. And then we got our returns here. It shows the investor cash flow, sponsor cash flow / company, and then the leveraged returns. And actually put that leveraged cash flow. Change that on both versions. This is just a blank version template, and another one is the one I'm gonna build for you guys right now. So distribution summary. This summary is just taking all of the information we have in the annual detail and putting it into nice clean rows. So you got revenue, gross profit, sales and marketing, G&A, research and development, total operating, then total expenses, which is taking your cost of goods sold plus that. You got your EBITDA down here and your EBITDA margin or profit margin. We got a nice chart here showing nicely each year's revenue, expenses, and earnings before interest, tax, depreciation, and amortization. Then we have, so this is a really nice top level summary to see everything. And what will get really interesting is when you actually start building your own scenario and do things that match what you're doing. The summaries, the visuals, and the summaries and distributions, that stuff starts to get more interesting when it actually means something to you. So then we have our annual detail. We'll start with the monthly detail because they're both the same, but one's by month. And this is where you're getting all the movements. So you've got our starting users, and this is where we're pulling from the base revenue, or revenue sensitivity based on whatever that is, and we're getting free users added, free users lost, newly added free users converted to paid, free users from total pool converted to paid. So this is our free user pool tracking. Then we got our paid user pool tracking from that. And then based on what's in the paid user pool, a percentage of all those go through to all the tiers. So we got tier 1 revenue, tier 2 revenue, tier 3 revenue, tier 4, and so on. And all of these all perfectly align with any of the assumptions you pick, depending on the month you pick. Let's say we do tier 2 starts in 2019 or March 2019, and they only get 5%. Now let's increase this to what, 25? What did I decrease that by? 10. So this will be 20. Just to make it match. So tier pricing 2 now should have less people than it just did, and it shouldn't start till March of 19. So let's look. Where's tier 2? Oh, okay, so it hasn't started, and now it's starting, and it has less than it did. Well, it does. $905. So end tier 2 users is 905 if we just undo what we changed. You can see now, oh, it's 2,700. So I got all our tiers, got all our recurring revenue. We've got our ending month total free plus user count. So this gives you your total users that are on your server that you have. Then we got our total revenue just aggregated here. We also track a pool of the total paid users and your total MRR, so you can see, you got your individual lookup and then you got your summaries. And all this is grouped on the side, so you can hide all of this if you don't want to see it and just see your consolidated view. Oh, there's a lot. The model is intense. There we go. So that kind of shortens it up a little bit. Let me undo that. Oh, maybe it can't undo it. I just used the 1 and the 2. I forgot I could do that. Okay. All those are undone. Yep. So then we've got our costs. So those just come through per what I wrote in. So you can see right now we have nothing but VP of Marketing started in January 19 per month. We found our CEO. We started in January 19 as well. Founder and CTO going from the start. VP Success. You can see that did change through 6,000 by the end of the 5th year. Then we got our variable costs here. Cost of goods sold. Total of everything, all costs. Gross profit. Now I wasn't sure, but I didn't want to make it confusing since we already have gross profit on the annual or on the main summary, but it's sitting here. It doesn't really interact with anything, but I put it so you can just see what the gross profit is on a monthly basis, which is just taking, you know, your total revenue minus the cost of goods sold. Then EBITDA is just doing your total revenue minus the total costs. Then we've got other cash flow items. So we have our startup costs. Obviously that happens in year 0. Cash from the exit, which is defined on that control tab. You can see here we're exiting in the final year. I'll show you what it looks like if you don't and if you do it earlier. Loan payback, because we got the financing of 300, it's down to, you know, a 10-year term, 5% interest. It goes down to, by year 5 we owe 170 on it. If I put this at 0, that goes away. That goes away. And financing, now if I, let me add that back. So 250,000. And don't worry, stay along with me because the end is going to be nice. If once you see the cash, the way it determines your cash requirements is pretty cool. So again, we've got our financing here. Here's the debt payments that you can see just popping in there. What else? Then we've got our project cash flow. So again, this doesn't take into account any debt, or I mean any financing or financing effects. Then we got our running cash balance. We got a break-even month here. It's 52. You could probably put that somewhere else as well. Put it at the bottom. Break-even month. I'll just equal the max of where was I? This. There we go, 52. The key is I've tried to build as much summaries in as I possibly can, but one of the most valuable parts of the models I build is that all the data is structured really nicely and in a timely, in monthly and annual summaries, so you can do all kinds of queries on it and visuals or metrics. You can build a lot of summary sheets. I've just tried to do the main ones that are common and then some of the key metrics, but the way I've built the structures allows you to build, you know, internal rate of return schedules and everything else really easily. Right. What else do we have here? Project cash. So leverage cash flow. So this is just the same deal as the project cash flow, except for now we have debt service. So you can see this is different from the project cash flow by the amount of the debt service, and then the actual starting flow different from the project cash flow based on the financing coming in. Then we got our running leverage cash position. What did I do here? So this is summing up. Oh, right. So this is the running leverage cash is summing up just the leverage cash flow. But the leverage cash position is also taking into account, so it's doing the startup cost, the financing, so that's net of a 220. It's also doing your required cash needed by the owner, assuming you're doing this leverage and you're not having any investors. So it's saying you're putting this 223 in as cash at the beginning. So then you could see and prove to yourself that based on the monthly cash flows, do you ever hit zero or go negative? And you can see this is going to get really close. Look at that. It actually got to $0, and then it starts to go positive. So you don't actually have a negative month. And that is very cool. A very cool feature that I built into this. So let's talk about how that works. So if we go back over to the control here, we've got investor assumptions. We just put this at 0 for now. Well, let's back up here. So we have cash needs. So this is saying the lowest cash position, including financing. So if you're looking at all the cash flows and the payments back to the bank, you and all the operating cash flows, you will hit $223,000 in the hole. So you need to actually have that much cushion to survive your business endeavor. Then we have the cash position of the project alone at 378. So this is assuming we're not getting any financing. We're just starting whatever the startup cost is, and then all the running cash flows. The lowest point we hit is 378. Now in this 378, this is where we have to look at the loan amount and the cash needed. You can see the loan amount is going to be whatever you put into here. So I put 250, and then the cash needed is actually going to just do the negative of that lowest cash position. And that's for financing. That's if you're financing. So you kind of see here, based on whatever your projections are, how much cash you're going to need to survive. Including in this loan, obviously includes the debt service. So this now $473,000 will theoretically, if things go as planned, get you through and will be enough. Now, obviously, things that planned, anything could change at any time. But the purpose is to model out scenarios and test various things that could happen to see, what your business looks like in such cases. So there's that. Now if we go over to the investor assumption, so let's assume we have investors and they're just pooled all into one pool, and that can be broken down further if needed. If you have 5 investors or the different equity splits at different times. That hasn't been dealt with, but what I've done is just built this for a overall investor pool. So assuming you have the company on one side or the founders and then the investors on the other side. So this says the total cash needed to stay afloat, the 378. So that's obviously no financing happens. You don't have to pay out debt, but you don't get any cash up front. So you're going to need 378,000. So that's where the cash needed for a project to float. It comes in right there, and then if whatever the investor puts in, let's say 150,000. Well, now the investor gets 39%. The remaining cash needed is how much whoever else has to put in, or the founder or the company, and then that's the 60% there, and that's just based on who's put in what compared to what cash was needed. Now, based on these inputs and results, you'll have the distribution tab populate accordingly. And now that you've seen how all of the cash flow works, this might make more sense. So you can see the investor puts in 150. They're getting back their share of the returns, which includes the exit value. or if you don't think it's going to sell, you could always just put this to 0. And no exit value included there. Then we've got the company side of it right below. Internal rate of return of 22%. That's saying, well, I put out 150, and then in the 4th year I get back 85,000. 5th year I get back 300,000. That's the internal rate of return. Leverage 30%. Internal rate of return a little bit better, obviously, because you're putting up less cash up front, but obviously you're getting back less. This is 538. This is 593. A little bit more. That all makes sense. Chart works. Summaries. Annual users. We could talk about customer acquisition cost. So basically that's just doing your total sales and marketing. So sales and marketing is assumed this is your cost to acquire customers. Whatever is put into here. So this is marketing, product marketing manager, content writers, sales, account executives, sales directors, VP of sales, anything related to acquiring new customers. And you take that number and then you divide the total, what are we taking? 193. So we're dividing that total expense by the total paid users added. So this is how many users you've actually added to the business in the month net. And actually, hold on, that shouldn't be net, and this is why I go over this, because I catch these things before I actually release it. This should be total added users, because we don't, even though there's churn, we want to know how many total new people have become paid users for the month. So we'll update that, and that will change this a bit here. Yes, it did. It lowered the cost of customer acquisition cost, which makes sense. It should be lower because it means you're adding, your total is obviously going to be more than the net, which would lower the CAC because it's saying you got more users for the same cost. Let me adjust it on here. This is why I go over these things. Little things you catch. So that needs to be total, not net. And that's all 0 right now because I just have this as the blank workbook, or blank template to start from. Okay. So we've done that. Now gross profit per user, and let's check this one. It should be the gross profit that you're making, since this is all recurring revenue streams, divided by, and it should be, before I even go up there and look, it should be the, what am I doing? What metric is this? Gross profit. Oh, so divided by the total users, paid users. And that is 139. Oh, there, 66. So yep, that's right. And total paid users. So that really should say gross profit per paid user, but we're assuming users here are the paying users, the paying user pool. Then you got your CAC payback, so the amount of months it's taking for this customer acquisition cost to be paid back by the monthly gross profit. So that's a simple calculation now that I've separated this out, which is just the cost divided by how much you're making a month. So if you, let's just say it cost you $300 to sign up a customer, and their gross profit per month is $50, it's going to take you 6 months to pay that back. 6 times 50 is $300. $50 a month, 6 months. And you see we got that starts to populate now. Once we go positive, 128 months, 57, 36. You can see it goes down, and then really ideally between the 4 and 8 range is good. 4 and 8 months. Customer lifetime value, and that's again, it's kind of complicated, but that's taking the it's annualizing the monthly revenue or gross profit. And then you're multiplying that by the amount of years, amount of years you're expected the user to be there for. So gross profit per user per month times 12. There's your annual profit times the amount of years you expect them to be there. And that's your customer lifetime value. And then that could change, obviously, as your assumptions change. Holy cow. This is a lot, guys. I mean, it took me about... Normally I do models all in one day and try to get it done in like maybe 5 or 6 hours. This has taken me... I think I started it 2 or 3 days ago, and I really just had to do it piece by piece to make sure it was accurate, and it did everything I wanted. And it's because this is such a big business, or such a big niche. I mean, everybody, if you have a website or an app, you know, obviously there's a lot of companies that have websites or apps. So hopefully it'll meet a lot of demand. I guess that's all I got for you. Hopefully all the notes and this video and the comments throughout the model will help you get used to it. Again, the main thing is you're only changing cells in this color, and then just understand, make sure, you know, if things aren't looking like you thought they were, make sure you've hit all of the yellows, you've done what you wanted to them. I'll show you a couple more things. If we do the exit, let's say the exit doesn't happen till, or it happens before, so August of 21. You can see in the visuals everything stops then at August of 21. Yep, August 21. Okay, good. I'm just checking this too to make sure. Yep. Okay, and we're not doing the exit. We could do, let's say the exits, we get a 4 multiple on the revenue. There we go. 2021, yep. All that looks good. Now your distributions look better after you get that exit multiple in there. Internal rate of return 69%. 90% for leverage. Let's say we do none. No financing here. The leverage to IR is going to go down, but let's check it out. The cash flow will go up. Yeah, 69%. So that makes sense, because if you're not financing, then the cash flows are the same as the project, because this is just assuming there's no financing. So great, the math is working. That's good. That's a good sign. All this all flows. Oh, one quick thing. On the monthly, you will define your starting free user pool here. It could be 0. That's fine. You can put it at 0. 0 here. And you'll define that for each revenue pool as well. If you already have, and that only applies if you already have active paying users or free users. If you don't have any, you just put 0 in there, and then this will then populate per, you know, your revenue assumptions of when you say these are going to start. Okay, I think I've covered as much as I can. Again, if you want to purchase this, it is going to be an upper tier model, $125, and you just go to the link below in the description box. It'll take you right to my website, smarthelping.com, and I accept PayPal, which can do basically, you could pay with credit card. You could pay anyway through that portal. And so after you purchase it, I'll go ahead and send you it over. No worries. Usually I get that, you know, right away. It takes me maybe less than, you know, 5 minutes from me getting the email to me sending the model out to you. Alright, that's all I got for you. We got our model in. I don't know if this is a third. For smarthelping.com, let's see, how many did we do this month? I usually try to do 3 or 4. We could check it right now. So we did a P2P investing model. We did a cleaning, janitorial. So this would be the 3rd one of the month. I know this month has been crazy. I can't wait to do the monthly report. It'll be a big one, but I think June I probably made, as far as my financial consulting, it was the biggest month I think I've ever had in my life. Now it's not going to be crazy. It's not like I made $20,000 in a month, but I mean it's going to be from what I've been doing. It's going to be the highest, but I mean not by a ton. But so yeah, we'll get this one in. I'll finish up. I'll have to build a post out for it and everything here, but I am excited about this one. This is really a nice model, really dynamic, and it fits, basically a web business or app business. All right, see you guys on the next one.